Good day and welcome to this video on the Kerner Perspective report for local portfolio holdings for the half year to the 30th of June. Just a couple of quick comments before we dive into the holdings. The JSE is a funny old market, particularly the top 40. It's seen a lot of volatility in the underlying constituents, with the exit of SAB Miller and the corporate actions at Richemont more recently, before that BHP, and before that the Naspers Prosus transactions. So it's been a very volatile underlying constituent list. And also, quite importantly, a lot of those delistings and corporate re-engineerings happened when those share prices were at highs, which had the effect, we believe, of artificially locking in high levels for the top 40. A couple of other things. The South African market is shrinking. We're seeing a wave of delistings, and that is a source of some concern, although it does interestingly offer some opportunities. We believe that there's been a massive drainage of liquidity from the local market. There's not a lot of foreign interest in SA at the moment, and the South African institutions have obviously been aggressively taking money offshore following the increase in the foreign investment allowances. We've been tilting our portfolios increasingly towards small and mid caps, but not recklessly so, and also allocating considerably more to net asset value plays, where the view is that the risks where you've got a discount to NAV are significantly better on the upside than the risks on the downside. We don't, as a principle, chase rand protection. A lot of managers do, particularly in periods of currency weakness. And the reason for that is we allocate accordingly. We buy assets that we believe have good fundamentals. And the main reason for that is most of our clients would have offshore assets, and for that reason, we would get our offshore exposure directly there. And then also importantly, we have fairly limited commodity exposure. All right, so the South African small and mid cap world, we've labeled them unloved but worthy of love. And the reason for that is that a lot of these businesses are pretty decent. There's obviously been some catastrophic failures and a lot of companies just sort of rusting away. But if you look at that top graph, you can see mid caps. The mid cap index is at the same level as it was in 2015, and small caps are a little bit better than they were then, but not by much. So the question then is, why have mid caps and small caps underperformed so significantly? And we think it's in large part because of the drainage of liquidity from the South African market, and also I think the bigger institutions tend to concentrate on a handful of the bigger caps and sort of very selectively play in the periphery. And you can understand that, an Allan Gray or Coronation, to go and play in a 500 million or 2 billion rand market cap really doesn't move the needle much for them. But we're just going to quickly look at the example of KAP Industrial. You can see the share price below where it was 10 years ago and considerably lower than it was in 2017, 18, 19. And the question is, why has it underperformed so? Just some of the fundamentals on KAP. It's a diversified industrial business. The big asset, Safripol, which is a plastics business mainly. PG Bison, which has plantations and produces timber and plywood and Formica tops and so on. Then there's Restonic, which is a bedding business. Feltex, which is a supplier into the automotive industry. DriveRisk, which is a relatively new business, which is more of a technology company. And then Unitrans, which is obviously transport and logistics. Fairly balanced from a revenue point of view if you look at the year to June 2022, but Safripol it had a wonderful year and drove the earnings of the group, and you can see they're representing almost 50%. So Safripol did very well, but the combination of the July riots in 21 and the floods in KZN hurt both Restonic and Feltex quite badly, and Unitrans also battling to sort of pass on some of the cost pressures. All right, so you might think, well, I don't know KAP, who is it, and is it not a speculative company? And I think the short answer in our view is definitively no. It has got an asset base of around 30 billion rand. Of that, about 3 billion is in intangibles. I won't run through the rest of the balance sheet. Safe to say debt is fairly manageable. As at June 2022 was about 8.7 billion. They have borrowed a little bit, so that would have ticked up, but still you're looking at a business with a market cap of circa, let's call it 6 billion rand, with a net asset value of, let's call it 12. So it's trading at about half its net asset value, and even if you lob off the intangibles, you're still getting a massive discount of around 40% to asset value. So very, very cheap. So the question is, well, why is it underperforming like this? Surely operationally it's not performing, and we would argue that that's not the case. The blue bar here shows you the earnings per share, the orange bar, the dividends per share. As you can see, it's been a fairly consistent performer, save for 2020, where obviously COVID wreaked its havoc. Then 2022 was a fantastic year for Safripol. That made the earnings shoot through the roof, with 70 cents worth of earnings. This year it's going to moderate, probably around the 45 to 50 cent mark, a little bit below trend, but we believe it will pick up that towards trend. So the bottom line is, it's not a business that is battling to deliver earnings growth. So the metrics are, you're looking at a forward PE, obviously to June, which is historic, but they haven't yet released. Let's call it 6 times, and a forward to June of 24, which we feel comfortable with because there's been a lot of investment that will generate return of under 5 times, dividend yield historic 11, forward of 8, and as we said, a discount to NAV of anything from 40 to 50%, depending on what assets you want to eliminate. All right, so that's the case to be made for why we believe that some small caps are offering value. What we're going to do now is just look at the PE multiples versus earnings per share growth, and this sort of distills out what we do on a daily basis. The x-axis being the PE multiples, and the y-axis the earnings growth over 2 or 3, depending on how near the year end is, average earnings growth rates. And as you can see in that green block, companies on PEs of 5 or even less to around 11, with earnings growth of 5% up to almost 20%. And that's what we would call kind of that real value block. As you can see, some of the more compelling ones would be Standard Bank, Absa, increasingly Old Mutual now, with TFG and a few others as well. And then of course the internationals way out on the right. In fact, Richemont isn't even appearing here. It's so high. All right, then we have significant exposure to South African banks. This shows the rationale for that. This is the PE over time of Standard Bank over 20 years. And the orange line is the average PE over that period, a simple median. As you can see, it has had times where it's traded to PEs of 10 or less, but those are generally sort of, if you look at that 2008 period, that was the global financial crisis, 2016, sort of the finance ministry fiasco, 2020, obviously COVID. So we believe Standard Bank looking very, very cheap, because we haven't really got that crisis that a lot of those previous periods where we saw the multiples at these levels. Yeah, that's the Standard Bank share price. As you can see, it's up on where it was a decade ago, but not much, and still considerably below where it was in 2018. So the question is, what is wrong? And we would argue what is wrong is the valuation, not the fundamentals of the business. The 2022 year was still a period where they were busy rebuilding the income statement post-COVID. So, 37% increase in headline earnings. You must take that with a pinch of salt. But I think the key thing here is you're looking at a business who has delivered consistent, generally consistent earnings over time, sitting on a forward PE of around 8.5 times. The dividend yield forward is around 7%. Return on equity, in spite of big capital buffers, with capital adequacy at 13%. Fantastic returns on equity. So yeah, the fundamentals just look good. Similar story is true for Absa. Absa, like Standard Bank, has clawed its way back from those lows that COVID caused. The fundamentals ABSA, although a lot of people sort of feel it's a little bit stodgy. We wouldn't really agree with that. I think it's transformed itself in large part. But as you can see here, fairly consistent earnings growth. And the red line there is the share price. And as you can see, generally, the earnings are following that trend line. So the 2023 year, I think maybe a little bit too optimistic on these forecasts, but nonetheless, you're looking at very, very low multiples. If you look at the next big holding, Naspers, we've held relatively consistent weightings for some time. Even when it was 25% of the index, we weren't budging. And when everybody was crying in their soup, when the Chinese authorities clamped down, we remained committed. And really the story here is a simple net asset value. Obviously, Naspers into Prosus into Tencent. We've got to say we like the Tencent story, and we believe that Tencent is moving from being a tech play with high earnings growth to being a more traditional company, and it's going to deliver, we believe, solid earnings growth over time, and it's uniquely positioned together with the rest of the technology sector to help drive the Chinese economy into the fourth industrial revolution. The net asset value, as you can see there, of Naspers at about 5,700 Rand per share. So clearly sort of 3,500 Rand a share, massive discount to NAV. Shoprite is a business that the market tends to fall in love with and then get scared of. Not, I think, because of the fundamentals of the business, but because we tend to run away with the share prices. This slide says it all. Shoprite has an ability to make hay even when there's fairly little sunshine. The consumer environment has been tough, fiercely competitive environment in food retail, but you can see there consistent growth in market share relative to their peer group, and also very smart investments in technology. And for example, the launch of Sixty60, which has become a game changer for them. So we believe it is an incredibly well-run business. We believe that the earnings growth will be solid for some time. But having said that, we do feel that Shoprite is expensive relative to its peer group. So sitting as probably our fourth or fifth biggest holdings for many clients, not so much those that are fairly recently joined us. We think that the rating really is overcooked. And on further strength, we would probably look to lighten that and flip that cash into that green block that we spoke of earlier. Then Reinet. When Reinet was originally birthed, you'll probably remember it was just a British American tobacco story. It's now moved on. The investment in Pension Insurance Corporation is actually now greater than British American Tobacco. And as we expected, they've taken those strong cash flows from BATS as well as the sale of their holdings, and they've redeployed it into some interesting businesses. And we think Reinet will continue to do well. And as we're saying, it's no longer just a BATS story. Also, obviously trading at a discount to NAV. BHP, before the corporate action, did well over the decade, and tends to be a lot less volatile than the others in the commodity sector. And that's post the corporate action. Obviously, the corporate action was the BHP PLC listing evaporating, and we now have one single BHP listing. The reason we like BHP is because it is the steadiest performer in a generally unpredictable sector. As you can see in that top left graphic, the orange line is their margins through all cycles. But of course, what we like, if you look at the bottom graphic, consistent performance in earnings. They've got obviously the couple of dips in this current financial year, but we'll see a significant decline from last year's purple patch. But generally a very solid producer, good cash generator, and a very, very good portfolio of tier one assets. Then Aspen is quite a big holding. It's been volatile. The market, was in love with them in 2015 and then fell out of love with them unceremoniously when the fears were that they had too much debt and that management had stretched themselves too thin. From where we got in, probably around 250, we're starting to head back towards that sort of price. The COVID scenario and improved earnings did cause a rally, but it's, I think, one of those that's also not attracting flows because of the liquidity issue, but we like the fundamentals very much. If you look across, the silos, excellent diversification geographically, good product mix, very, very strong positioning in products such as anesthetics. You can see the debt that got out of hand. That's that bottom left chart, got out of hand about 5 or 6 years ago through sales of a number of assets and generally an improved environment. We've seen the debt come down to a far more manageable level. Earnings took a little bit of a dip over the last year or two, but we believe they will pick up that earnings momentum, and we believe, as we saw in that chart earlier, solid earnings growth with very undemanding ratings. All right, moving on to Remgro. We were quite critical of Remgro for the better part of the last decade, sort of viewing them as being quite static in the portfolio. But that all changed probably about 18 months ago when we saw the overtures to unlock value through the RMH and FirstRand transactions. But also there have been others in terms of the insurance portfolio, but increasingly active. The JV with Heineken to delist Distell, for example, and more recently the takeout of Mediclinic, very much pointing to the fact that they're open for business, and we like it, still trading at a decent discount to NAV. It is important, though, to understand that it's increasingly private investments and no longer listed. Speaking of which, Ethos Capital, we have to say the share price performance has been very disappointing. We have been quite critical of management or the board in not buying back shares, and also just maybe not, doing a great job at selling the story. But I think their view is that they are private equity managers. That's their job, and they've done that, we believe, that quite well. Obviously, COVID caused a lot of chaos in their portfolio, but if you look there, you can see the top 10 assets as at December last year, representing around 86% of the portfolio, with the biggest holding by some way being Optasia at 28%, which translates to over 55% of the current share price. And that is a really good business. So I don't want to dwell too much, but trading at around half its net asset value. If you look at the last 12 months in terms of revenue growth and EBITDA growth inside the portfolio companies, which is the important part, you can buy an NAV at a discount, but the NAV is invested in lousy businesses. That's not the case here. You're looking at mid-teens earnings growth across the portfolio. We've seen some realizations, and we believe there are quite a few assets sitting in the waiting room that will unlock value, and hopefully some of that will be redeployed to buybacks. Not overly valued in terms of the multiple, say, to EBITDA. So generally, we are very comfortable with the story. The only thing that's irritating here is the share price. Next up is TFG, the Foschini Group. It's a recent acquisition for us. Share price roughly the same as where it was a decade ago, and considerably below where it was in 2018, 2019. And this poor performance on the part of TFG is somewhat puzzling. As you can see, top right there is the earnings per share, dividend per share growth over time. Not spectacular, but it has been a very difficult operating environment. What we really like about this business is that it's got international operations that are very well run in TFG London and Australia. But we do feel that management have got a solid balance sheet. As you can see, their debt is well under control relative to shareholder equity. But they are a unique combination of being solid while also being positive. Up top there, we're illustrating the example of Jet that was bought from Edgar's, when COVID created a unique opportunity. Bash, which is an online retail platform that spans their portfolio. Prestige, where they've invested quite heavily in local clothing manufacturer to help produce lines when necessary, and also to help compete against some of the imports from China, for example, from Shein. And then Tapestry, which is a very recent acquisition. So we feel that it's a very good business. It's well run, good balance sheet, and we believe that there'll be strong earnings growth as the earnings restore. Then Sasol, it's been, everybody knows the story. It used to be one of the blue chips, but they really lost that blue chip status when they mismanaged the Lake Charles project. And that leads us to this slide where we say Sasol own goals are plenty. Obviously, the massive increase in debt and the mismanagement of the Lake Charles project were important, but equally there was a lack of hedging discipline during the COVID era, so that when oil prices collapsed, they didn't have the hedges which have been in place consistently for, I would argue, decades. As you can see there, the top graph there showing the debt picture, which was really out of hand. Nice for them was a rebound in the commodity prices, weakness in the rand, helped them bring that debt down. Of course, been some sales, including a dilution in Lake Charles. But I think the main reason we are earmarking Sasol for sale is in that graph just below that, which shows the earnings per share. We're looking through that sort of COVID period, but really what we're seeing is a business that has fairly consistently delivered sort of between, say, 30 or 40 Rand per share and 50 Rand per share. But over a decade, the earnings haven't really gone anywhere. And of course, there's the overhang risk of greenhouse emission taxes. Prosus is really just an extension of Naspers. As we've said, we prefer Naspers, but we believe that efforts will continue to be made to narrow the discount from Prosus to Tencent. Anglo American share has been all over the park over the last decade. Risks, people with the market saw anyway, was of an insolvency back in 2016. We thought at the time that was daft. You've seen the business recover quite significantly. It's not of the quality of BHP Billiton, we don't believe, but it is positioning itself for a new world. For example, in a less carbon intensive economy, for example, where Amplats is a big proponent of the shift towards hydrogen, but also, moving strategically towards food with the investment in an agricultural commodity business. So the half-year results to June 23 showed quite a significant decline in earnings on the combination of commodity prices and some supply or production issues. But generally, as we say at the top there, Anglo American is a much better business today than it was maybe 5 or 10 years ago, and you can also see it in the mix of the earnings. Then City Lodge is a business that's really been to hell and back. It was very much seen as a darling of the market. We haven't held it for that long, but it has been a big loser courtesy of COVID, where a couple of things conspired. COVID itself, but of course they had to do a recapitalization because of a BE deal that needed refinancing. So a massive dilution courtesy of a lot more shares in issue, but at its core, we believe this is a good business. We believe that Andrew Whittaker and team run a good operation. They're good hoteliers. They understand their market, just mainly business, but increasingly enjoying benefits of inbound tourism. But as you can see there, the group occupancy ratio and the average room rate, in spite of headwinds, back above where they were at the comparative period in 2019. So I think for us, the big story here is that it's really a property company that trades at a massive discount to NAV, but it operates as a hotel. So, arguably the share price is trading at probably a quarter of what it would be a realistic net asset value. So we feel good hospitality operators, but with the downside protection of a very, very good NAV. Discovery is a business that we sort of sang the praises of. We sort of drank the Kool-Aid around the Vitality shared model and the cross-selling and the sort of development of new ventures by channeling operating profits into the likes of Insure and Invest and Ping An, for example. But we have been trimming our holdings. About a year ago, we sold down quite significantly. It was at the time probably the biggest holding in most client portfolios. We trimmed that from around 8% to about 4.5%. We more recently have trimmed it back down again so that it's down to a very modest sort of 2 or 2.5% in most client portfolios. And the reason for that is we believe the gears are slipping. Firstly, we feel that that insurance business, which in large part is the engine room for the profits of the group, is at risk. Immigration, but also affordability. A lot of affluent South Africans just cannot afford these premiums anymore. But also, we feel that the Vitality model, frankly, is losing vitality. The rewards program didn't do what it was supposed to do, and I think there's also quite a lot of fatigue, and we're starting to see more competition in this space. Virgin Active is an example, but we believe more and more international players will start eating their lunch. So it's a business that we've decided we want to get out of, and further strength, we will look to exit the final positions. Then we've got Argent here, which is an interesting little business. And, I remember many discussions with clients over the last, 5, 6, 7 years, where the question maybe 6 or 7 years ago was, why have you got this crazy little small cap in here? As you can see, the share price for, from 2013 up until 2021 almost did nothing. For us, it is in many ways the poster child for value investing and the patience that is sometimes required. So if you look, for example, what the earnings per share have done, from 2013, when the earnings was about R1, almost R1 a share, it obviously slipped down on a combination of factors. But we could see the management doing the right things, shutting loss-making businesses, selling off non-core assets, using the cash flow to amortize debt, focusing on some new opportunities that were going to generate better returns, as well as share buybacks. And that combination, as you can see there, in the last couple of years has just absolutely propelled the earnings. And then importantly, the current share price, the share price where it was literally 5 or 3 years ago, around R4 a share, as you just seen, is effectively the same as what the earnings were that were just released. York Timber is a business that we like. It's quite a small holding, very illiquid. We like the A Squared involvement. They're activist shareholders. Obviously, the recapitalization or the rights issue did dilute. We followed rights. We continue to believe in the story. And it's obviously in large part driven by the fact that the trees in the ground, we believe, have a significantly higher value than the balance sheet. And the balance sheet itself is probably reflecting relative to the current share price. You've got a company trading at, call it R2 a share, that's probably got a net asset value of 10. And we believe that 10 is probably fairly conservative. But it will take some time for the operational results after all the gyrations we've seen in the timber lumber market to play out, but we're very confident of the value proposition here. Then Richemont, post the corporate action, that was obviously, when the depository receipt was flipped into an inward listing, the share price has come off quite a bit. We believe that it's still a good business, but the earnings are actually a lot more volatile than we would think. Then a relatively recent acquisition in a number of client portfolios, but we obviously have to be careful not to overburden portfolios with private equity, NAV stories, and small caps. But for a lot of clients, we have been adding African Rainbow Capital. And really what we're saying is that, if the billionaire brother-in-law of the president with very, very competent managers and networks is unable to operate an investment holding company successfully, then we're in deep trouble. Really, it's kind of got two models to it. It's classic private equity, where they own everything around from property and business processing and agriculture and a whole lot of others, as well as a financial services portfolio, which is the one on the right-hand side. There's a lot of businesses in there. We believe that they're very complementary, and we believe that what they're actually doing is they're busy building a financial services company for the future. And we believe this business will trade well. Two of the bigger assets, TymeBank, which is trading incredibly well, growing its numbers and is expanding very excitingly into Southeast Asia. and then Rain, of course, which is the network operator. CUP we've discussed in great detail, so I won't go through it again. Safe to say that the story is good. The only thing that's missing is the share price. And then a couple of shares that are in client portfolios, but we haven't talked to here. The likes of FirstRand, and what was true for Absa and Standard Bank is true here, with the possible exception that FirstRand has been the star performer, and we believe that the earnings growth that was so superior to the peer group is going to moderate. It's going to come towards the pack, and we'd rather buy the cheaper ones. Bidvest, Bidcorp, obviously both very, very good businesses. We believe that Bidvest is largely a GDP kind of proxy, and there's a logical price to pay for it, and we don't see that price in the current environment. Bidcorp is an exciting business, and I think out of the two, between Bidvest and Bidcorp, we would argue Bidcorp is the better business. Investec, much improved business today to what it was. And then 91 and Coronation, exciting opportunities if you believe that the equity market's going to do well. Both those businesses looking cheap, particularly Coronation, courtesy of the tax fine or the tax settlement that is going to have to be made. But when that passes, you've got a business that really does have a license to print money. Similarly, Old Mutual looking very energized, looking strategically ready for the future. And then Bell Equipment, which is a very, very small holding. It's an incredibly illiquid business. It's, we believe, a fantastic NAV story, and we believe that it will be delisted. Unfortunately, there's just no liquidity with the family owning over 80%. And then finally, Woolworths, which is a legacy holding, we've pretty much earmarked for sale. So that really concludes the portfolio holdings. We trust that you found this insightful and valuable. If, as always, you've got any questions or comments, please feel free to contact us. Thank you for your time.